Welcome back to the session. The last session you could have watched net income approach. This session is about net operating income approach. That is number 2 in capital structure theory. Net operating income approach suggests that value of the firm is dependent on operating income and the associated business risk. Change in the leverage, that is debt, fail to affect the value of the firm. Assumptions: overall capitalization rate remains constant irrespective of debt. Value of equity is the difference between total firm value minus value of debt. Weighted average cost of capital remains constant. We will explore the topic. Net operating income approach to capital structure believes that the value of a firm is not affected by change in debt component in the capital structure. The previous theory, if we include debt or we increase debt, it will affect our capital structure. That's what we have studied. But this approach is different from the previous one. Here, it is believed that the value of the firm, that is value of debt plus value of equity, that is equal to value of firm, which is not affected by the change in debt component in the capital structure. Let us say the company which has 100% equity, the company which has 10% debt, it is increased to 30-35%, okay, which will not affect the value of the firm. It assumes that the benefit that a firm derives by infusion of debt is negated by simultaneous increase in the required rate of return by equity shareholders. With an increase in debt, the risk associated with the firm, mainly bankruptcy risk, also increases, and such a risk perception increases expectations of equity shareholder. Yes, when you are increasing a debt in the capital structure, equity shareholder would expect more returns for his capital invested. Clear? When you increase the debt size in your balance sheet, the equity shareholder expect more return, because when you are using the debt, when you are increasing the debt, the risk is slightly more than without using it. Here, the equity shareholder, that is the owner of the firm, taking that risk to maximize the return. So you know that under risk management, high risk, high return, moderate risk, moderate return, low risk, low return. So he's taking higher risk by borrowing money from third parties. So higher return has to be given, correct? Okay, this approach was also put forth by Duran and totally differs from net income approach. Also, as famous traditional approach, net operating income approach suggests that change in debt of the firm or company or change in leverage. See, change in debt and change in leverage are one and the same. The previous problem I explained what is leverage, right? By borrowing debt at a fixed cost to procure the asset or to purchase the asset, correct? So this approach, that is net operating income approach, suggests that change in debt, that is increasing debt or decreasing debt, will not affect or fail to affect the total value of the company. As per this approach, the weighted average cost of capital and the total value of company are independent of capital structure decision or financial leverage of a company. See, capital structure decision and financial leverage are one and the same. You know it because we have discussed in the first unit. Okay, so weighted average cost of capital and the total value of the firms are independent of capital structure decision. It means whatever may be the capital structure, whatever may be the debt and equity proportion, that will not affect the value of the company and the weighted average cost of capital. That's why they mentioned it as independent one. As per this approach, the market value is dependent on operating income. What's operating income? With EBIT and associated business risk of the firm. Both this factor cannot be impacted by financial leverage. What is financial leverage? That is getting loan from a third party at a fixed interest to procure or purchase some asset, correct? Long term asset. That's what we call as financial leverage. So this approach, as per this approach, the market value is dependent on operating income and the risk associated with it. Okay, the market value is independent. It will not get affected by debt size of the company or increase in leverage or increase in financial leverage. Financial leverage can only impact the share of income earned by debt holders and equity holders, but cannot impact the operating income of the firm. Of course, true in some cases, the financial leverage, okay, can have the impact on the share of income, because when you are using a financial leverage, when you are getting a debt, you are going to pay them interest. Okay, so it will have the impact on debt holders and equity holders. So after whatever paid to the debt holders, whatever is left, that is meant for equity shareholders. We can say financially it is called earnings available for equity shareholders. That part may get affected because you are going to pay a considerable interest amount. If you are getting a higher level, I mean, if you are going to pay a higher rate of interest, definitely it has its impact on equity shareholders dividend. Okay, so always try to keep your cost of capital minimum, but cannot impact the operating income of the firm. Operating income, sales, correct? It cannot impact the sales part, gross profit, and the net profit part. That's what we call as operating income. Therefore, change in debt to equity ratio cannot make any change in the value of the firm. Therefore, change in debt to equity ratio cannot make any change in the value of the firm. Got it? It further says, with the increase in debt component of a company, the company is faced with higher risk. To compensate that, equity shareholders expect more return. So thus with an increase in financial leverage, that is increase in debt size, the cost of equity increases, because when the debt size is slightly more than equity shareholders fund, what happens? The equity shareholders started losing their control over the company. Now the debt holders will play the major role. So the company should always keep the debt size should be less than equity size. Assumptions under this approach: the overall capitalization rate remains constant irrespective of degree of leverage. It's this method says you get whatever loans you want, but the interest rate, the rate which I'm going to pay back to the investors, the interest received by the investors, the return received by the investors will remain same, will remain constant. Okay, at a given level of EBIT, the value of the firm. So value of the firm formula is EBIT divided by overall capitalization rate. Correct. This also we have discussed in problem part. Value of equity is the difference between total value of the firm minus value of debt. That is the difference between total value of the firm and total value of debt. That is called value of equity. So that is expressed as value of equity equal to total value of the firm minus value of debt. Weighted average cost of capital remains constant, and with the increase in debt, the cost of equity increases. An increase in debt in the capital structure result in increased risk for shareholders because you are expanding your operations. Let us say you are starting another branch. Okay, under the same company you are starting another branch. So you borrow money through debentures instead of shares. You borrow money through debentures. Now the profit arises, shareholders will be happy because they get more than their expectations. In case if you incur a loss, in case if the new branch incurs the loss, who will bear the loss? Because the new branch is funded by debenture holders, correct? But equity shareholders are owners of both the parent company and the new branch. So when the new branch makes loss, who will bear it? Here, equity shareholders cannot escape by stating, "I haven't invested in the company." He cannot say that because it is part and parcel of the game. The new company is not a separate venture. Try to understand. The new company is a new branch of the particular company. For example, ABC Limited having a branch in Chennai, correct? There is branch number 1, and it has opened a new branch in Pune. There is branch number 2. Both are ABC Limited. Try to understand. If that is the case, loss arises. Who will bear? Can you say that the company is totally funded by only debenture holders? I have funded only for the Chennai branch. You cannot say that, because as a equity shareholders, you hold the ownership of the company. Any profit arises from Pune branch, you are claiming, right? So any loss comes, you should bear it up to the limited liability you agreed for. But no debenture holder will bear the loss made by the company because they are not the owners of the company. Is it clear? They invested in the company because they get, let us say, around 10% interest per annum, and their capital is safe. It can be redeemed, or in the later on stage, it may be converted into shares. Clear? So this is what all about the net operating income approach. Next one is Modigilani and Miller approach. The Modigilani and Miller approach to capital theory, devised in the 1950s, advocates the capital structure irrelevancy theory. Advocates the capital structure irrelevancy theory. This suggests that valuation of the firm is irrelevant to the capital structure of the company. That means valuation of the firm does not depend upon capital structure. Whether a firm is highly leveraged or has a lower debt component has no bearing on its market value. Rather, the market value of firm is solely dependent on operating profits, that is EBIT of the company. Clear? This suggests that value of the firm is irrelevant to the capital structure of the company. So when you say irrelevant, there is no relationship exists, correct? So there is no relationship between valuation of the firm and the capital structure of the company. So capital structure, you know very well, right? Debt and equity mix. So debt and equity mix cannot impact the market value of the firm. Whether a firm is highly leveraged, that is, the firm is receiving high level of debt size, or has low debt component, or the firm is having very minimum debt size, has no bearing on its market value. That is market value of firm. Rather, the market value of firm is solely dependent on operating profits of the company, that is EBIT. It it is very similar to net operating income approach. That's why they mentioned the fundamentals of the Modigilani and Miller approach resemble that of net operating income approach. Clear? This is what we have discussed in the previous model also, where the capital structure will not have any impact on market value of the firm. The Modigilani and Miller approach further states that the market value of firm is affected by its operating income apart from risk involved in the investment. So EBIT is affecting the market value of the firm. It is true in many cases. For example, when the company's net profit is good, it affects the share market, correct? In a positive way. That means the company share value will go up because the company signs the new MOUs with many leading corporations across the world, or the company's net profit increases, the share value will be bullish. Correct? It means it is increasing day by day. Okay. In case the same operating income, the company incurs last in the last 2 quarters, what happens? The share value dips down, comes down. Correct? So Modigilani and Miller approach advocates that the market value of firm is not dependent on its capital structure, rather it is depending on operating income EBIT of the firm. The theory stated that the value of firm is not dependent on choice of capital structure or financing decisions of the firm. Modigilani and Miller approach as two proposition without taxes. Proposition 1. With the above assumptions of no taxes, the capital structure does not influence the value of firm. So when you include taxes, the capital structure may affect the valuation of company. Without taxes, the capital structure does not influence the valuation of the firm. In other words, leveraging the company. What is leveraging the company? Increasing the debt size of the company does not increase the market value of firm. In other words, leveraging the company, that is increasing the debt size of the company, does not increase the market value of the company. It also suggests that debt holders in the company and equity holders in the company have the same priority. How come that is possible? Practically, it is tough, right? Because the equity holders are holding the ownership of the company. The debt holders are just financiers who funded for the company growth. So they come in an interim mode. Let us say I fund this company in the year one, so I may exit by selling my debentures, or it may be a redeemable debenture. At the end of the fifth year, I may go out of the company. But as a shareholder, I purchase the company share for rupees 10. I wait for 20 years, so the company's share become 200 or 2000 rupees based on the performance. So this is highly contradictory. As per Modigilani and Miller method, they treat both the debenture holders of the company and equity holders equity shareholders of the company have the same priority? Definitely no. Even I could say debt holders are having more priority. Debt holders are having more priority because once you get the operating income, go to the problem aspect. Once you get the operating income, okay, that is EBIT. Who takes the first share? First share of profit. Interest, correct? After EBIT, you put interest. You check out any problem, whatever we have discussed so far. After EBIT, interest comes into picture. So equity shareholders are not given priority because they are the owners of the company. They may take either loss or profit. That's up to them. But debt holders or debenture holders or bankers do not take part in your losses. So from the earnings before interest and tax, first part you should declare is interest. So who gets the interest? Debenture holders. But for theory's sake, both of them are having same priority. And on those days, earnings are split equally amongst them. See the period in 1950s, the 70 years ago, it was accepted the earnings are split equally among them. That is, owner take the equal share and the lender takes the equal share. Who are the lender? Debt holders are lenders. Who are owners? The equity shareholders. Got it? Proposition 2. It says the financial leverage is in direct proportion to the cost of equity. With an increase in debt, the equity shareholders perceive a higher risk to the company. For example, a company which is 100% funded by equity shares. There are few companies are there which has zero debt, totally funded by equity shareholders. Let us assume that you are one of the equity shareholder enjoying the ownership of the company. Now the company decides to go for a 40% debt size and 60% is the equity proportion. What is your psychological feel? You feel the risk of losing the ownership. You feel the risk of giving away a part of share of your profit as interest. Okay, that's why it is mentioned that with an increase in debt component, the equity shareholders pursue a higher risk to the company. Hence, in return, because as per the risk management theory, high risk, high return, correct? These people are taking higher risk by employing debt. Hence, in return, the shareholders expect a higher return, thereby increasing the cost of equity. A key distinction here is that proposition 2 assumes that debt shareholders have the upper hand as far as claim on earning is concerned. Yes, that's what I said. As soon as you get EBIT, that is your operating income, you declare the first part to the interest, that is debt holders. Correct? Thus, the cost of debt reduces. Okay, these are all assumptions of Modigilani and Miller approach. There are no taxes at all, but in practical world, taxes are applicable. Transaction cost for buying, selling securities is considered as nil, as well as bankruptcy cost is considered as nil. There is symmetry of information. It means all the information will have access to the same information that a corporation would have. It means both the corporate company and the individual investors will access the same information, will thus behave. So investors will thus behave rationally. The cost of borrowing is the same for investors and the companies. There is no flotation cost such as underwriting commission, payment to merchant bankers, advertisement expenses, etc. There is no corporate dividend tax as well. So all those points we have already discussed in the previous model. That is net operating income approach. The Modigilani and Miller approach indicates that the value of leveraged firm. What is leveraged firm? The firm uses both debt capital and equity capital is same as the value of unleveraged firm. What is unleveraged firm? The firm which is not using its debt capital. The firm is using only equity capital. Clear? The Modigilani and Miller approach indicates the value of leveraged firm is same as the value of unleveraged firm. If the operating profits and future profits are same, that is the condition. So when operating profit and future prospects are same, the value of both the leveraged and unleveraged firm will be same. That is, if the investor purchased the shares of leveraged firm, it would cost him the same as buying the shares of unleveraged firm. There is no difference. That's what he advocates here. Okay, Modigilani and Miller approach. Snapshot. The theory stated that the value of the firm is not dependent on choice of capital structure or financing decision of firm. On the contrary, it is affected by its operating income apart from the risk involved in the investment. The approach was devised by Modigilani and Miller during 1950s. It resembles net operating income. Assumptions: tax rate is zero, transaction cost is zero, same information access to investors and corporates, flotation cost is zero, corporate dividend tax rate 0%. Proposition 1 and 2. Proposition 1, the capital structure does not influence the value of firm. Debt holders and equity holders have same priority. Proposition 2, financial leverage is in direct proportion of cost of equity. That means if you increase debt size, the equity shareholders expect more returns, that is more dividend, correct? So it is mentioned financial leverage is in direct proportion to cost of equity. With the rise in debt, the equity shareholder pursue higher risk. This we have discussed in the theory part. So proportion with the taxes, it assumes the existence of taxes, therefore tax benefits due to interest payments are recognized. So cost of debt reduces by interest tax shields, therefore change in debt component can affect value of the firm.